Hey guys, Brian Stevens here. Listen, Carl White and the Marketing Animals, want to let you know that you could get that would be no cost whatsoever, a free demo to Loan Officer Freedom to see if you like it, if it's going to help you with the business. Kick the tires of this thing. Check it out, take it for a test run, and see what you think. It might just be that thing you need in order to get your business going in the direction you want it to go. Click this right over there. Now, did you know non-banks originated 91% of all FHA loans in 2021? That's up from 57% in 2010. Now, why is this? Well, because policies, my friends, they have consequences. And the policies to ruthlessly sue deep-pocketed depository banks like Wells, Chase, and Citi for decades over defects on loans has hit its tipping point. They just got out of the game. They want nothing to do with FHA loans anymore. Listen, I ain't a big fan of big bank mortgage lending like I am of regional independent mortgage banks and brokers, but I do recognize they serve a purpose and keep more options on the table for consumers, your clients. Evidently, it's just not the case with FHA. Now, from Housing Wire, in recent years, depositories have retreated from the FHA market, citing concerns over lawsuits for loan-level defects brought by the government. Independent mortgage banks, which have a different business model and regulatory structure, have largely supplanted the once dominant depositories when it comes to FHA loans. Mortgage banks act as intermediaries between borrowers and the government entities that set guidelines for mortgage lending. See, my friends, policies have consequences. I mean, when are we going to learn? Now, here's the point of today's show and another story which is flying under the radar, but it's a rather significant story. Ginnie Mae, the source of FHA, VA, and USDA loans, they're pushing for a 250% increase in mortgage servicing rights risk weight for non-banks. Okay, let's break down what that actually means. Non-banks, that's probably you, independent mortgage banks and wholesale lenders, risk weight. That is the minimum amount of capital that banks must have with the risk profile of the bank's lending activities and other assets, or in our case, servicing rights for these loans. Ginnie is saying independent mortgage banks will have to carry 20% of the servicing assets value on hand and 50% for all other types of loans outside of FHA. So if a non-bank lender holds $1 billion in servicing rights, they need to have $200 million on hand to have the rights to service that $1 billion of FHA loans. They would need to have $500 million on hand for all other types of loans. So in short, this ain't viable for most non-banks, virtually all of them. Here's what you need to understand. If a borrower quits making their payment on that note, the servicer is still on the hook to satisfy that payment to the note holder or holders of that contract. Yes, they have recourse to get their money back, but you can imagine that if everyone quits making their payments at the same time, kind of like they did back in 2008, 9, and 10, the risk weight of 20% would get chewed up very quickly. Thing is, if 2008 happened again, 20% would not be close to enough money they'd have to have on hand. So as the thinking goes, Ginnie's economists might see very turbulent waters ahead, and they're trying to make adjustments now. But back to the point of the 250% increase in risk weight for non-banks when it comes to servicing rights on FHA loans. See, this can have extraordinarily wide-ranging ramifications for the mortgage companies that we all work with right now. For example, there are independent mortgage banks, as we sit here today, and wholesalers that are keeping their doors open solely on their servicing portfolio. Meaning, writing loans right now is a losing proposition, losing money for a whole bunch of mortgage companies out there and wholesalers. Servicing loans are keeping these guys from going under. So this change, which most wholesalers and independent mortgage banks won't be able to afford, so they'll lose their servicing, is going to put all these lenders on more shaky ground and will lead to fewer options for your consumers when they have to scuttle their businesses. The second thing is higher interest rates. Yeah, that's right. If there are only a few players who can afford to service loans, then they could charge more money for their service. This is pretty simple. It's Econ 101, isn't it? The higher cost for servicing loans will make its way down to every rate sheet in the country where your clients are going to get to finance this policy on every loan they ever get from the day after this thing passes. And this is really maddening because it's altogether unnecessary. Servicing has worked extremely well short of a few years around 2010, which would have still been a problem with the higher capital requirements of today. So to suggest a move that's 250% higher makes me think this is less about sound policy from Ginnie and has a hell of a lot more to do with individual agendas whose palm is getting greased for this thing. I guess we'll find out if this goes through. Hopefully not. However, if you would like to add your 2 cents, they are certainly interested in hearing. To do so, all you have to do is click the link down below and let them have it, boys and girls. With that said, can't wait to see you until Tuesday. Make it a great day.